What is the market telling me this week? This is the Nick Rutherford Report, and you are either getting taken advantage of by the market or you are taking advantage of the market. So hit that like button, subscribe to this channel, share this with someone who would get a lot out of it, because this is the financial news that matters for your net worth. So what is the market telling me this week, and what should I be paying attention to? Let's get to it. There's been some big news this week that I think is worth paying attention to. First off, I'm not being political here at all, but it's important to point this out. Apparently, Powell said there's an argument that payrolls may be a bit overstated. And why am I finding this so interesting? Because for a long time, people have been very confused about the economy. Is it doing well? Is it doing poorly? And this goes with the theme that I've been following, that there are segments of the economy that are doing great, and there are segments that are going to be doing bad based on the economic conditions. And I want to invest in things that are going to do good, not in things that are going to do bad. So we're going to look at the market to tell us what to do. Some other news that came out that was very interesting here is that initial claims surged to a 10-month high as California job loss soars. Why is this so interesting, and why is this happening? Well, the most important thing that I'm watching in the market is the jobs, because one person's spending is another person's income, and that can create a cascading effect. So when you see things like 10,000 California fast food workers fired thanks to $20 minimum wage. Now, whatever the reason they're actually firing these people, whether it's because of the political thing where they're raising the minimum wage, or if the economy's slowing down and they're using it as an excuse to fire people or automate, it doesn't really matter what the reason is. All I'm doing is watching it because it's happening. And this just goes along with the unemployment report that came out in June 7th, 1 week ago. We hit 4%. Now, 4% unemployment might not sound like a lot, but I want to bring up this important chart because this is what we really need to pay attention, and I'm paying attention to what the market is telling me here. Now, if you look at this graph from the Fed, or the Fred, I misspoke there, the St. Louis Fed, it's printing the unemployment rate, and this goes back to the 1950s, and you can see that every time the unemployment rises, we have a recession. It's marked out in gray here, 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 here. So what always happens before a recession? Unemployment is low, and then unemployment begins to tick up, and it's starting to tick up. So this has got me paying hyper attention to the jobs market because, like I said before, one person's spending is another person's income, and that can have a snowball cascading effect on negative earnings. And when that starts to happen, historically, and I say historically because usually the job market becomes a problem, and then earnings become a problem, and then investment prices go down, stocks go down, real estate goes down. Just why? Because there's not enough money floating around in the economy. And there's always a possibility that this time will be different because the amount of debasement they'll be doing. But if we look at history as a guide, if unemployment continues to deteriorate, it's more than likely all asset prices will decline in value, except, of course, long government bonds, because if the economy is slowing that badly, they'll be cutting rates like crazy, driving up the price of bonds. So I'm waiting for signals to tell me what to do, but right now the market is still going up. So I'm not too worried about it, but I'm watching this very closely. And I bring up this article next that is very important, not because it's talking politically in any way, but just the consumer sentiment unexpectedly slumps to a 7-month low. So this means people are very unhappy with the way the economy is going. And I'm watching the news here through this website because it tells me all sorts of things. It tells me things that mainstream media necessarily wouldn't tell me. So I think it's important to look at all sides of everything so that we can really understand what the market is saying. And another thing that came out this week that's very interesting, Supercore, this is the CPI, became negative here. And why is this important? Because For the longest time, they've been raising rates, and we got to slow down the economy, and now it's really starting to slow down. So here, it's either going to stabilize or we're going to have huge problems. It's getting to that point in the cycle. And that propels articles like this. Consumer prices hold at record high, up 20% since Biden was elected. Why am I pointing this out? I'm pointing this out because just because the CPI has slowed down, it doesn't mean that prices are going down. It just means it's not going up as fast. And if rents are coming down from where they were, like in 2022 or 2021, super high, doesn't mean they're going back to 2019 levels. They probably will never go back to 2019 levels unless we had some sort of extreme catastrophic depression. And my thesis is, well, if there's a problem, they're just going to print more money. In fact, the Fed chair went on 60 Minutes and said something to that effect. He's like, well, we've got a tool for that. If the economy goes into deflation, we've got a tool for that. They don't have a tool for too much inflation. All they can do is raise rates and hope to slow the economy, to break it, to cause unemployment to rise, so there's less spending, and then everyone gets poorer, and that slows down the inflation. And you know what? That looks like it's something they're doing that right now. And this is why I believe whole segments of the economy are getting squeezed. And this is very important. I'm watching this because it's dictating what I should be invested in. What happens next and what am I doing about it? Well, let's look at this screenshot here. This was from an article that came out this week from Real Investment Advice. And this is a long-term interest rate chart. And the reason I'm pointing this out is because if you look way back here in the 1860s, interest rates declined and declined and declined for something like 50 years, 45 years. Then they went up for a number of years. Then they went down for a number of years. Then in 1954, they started climbing for a good 30-odd years, all the way up until the early 80s, and now they've been declining for 40 years until this spike. So why is this spike so interesting? Have things changed? Well, maybe they've changed, and if interest rates are rising, then bonds could do very badly. Real estate could do very badly. So all I'm doing is looking for themes and thinking what could happen next. And the market is telling me that if history is any guide, there could be a long-term trend of interest rates either trending sideways and then going up or going up from here. And this is going to cause massive problems. So I'm positioned myself just in case this is happening. And how am I doing that? Well, I've been in things like Bitcoin. The Bitcoin effect, that's why I bring this up. Onwards and upwards after the post-halving. Now, I've been in Bitcoin for a long time. I was scooping it up like crazy during the FTX blow-up when it was between $16,000 and $20,000. Why? Well, it seemed like it had bottomed because there was terrible news and it stopped going down. And now it's onward and upward for Bitcoin, at least until it isn't. And I fully expect it to crash again, maybe 80% at some point. But if history is any guide, we're in the time for it to go up. And all of these themes that I'm following seem to suggest that it will. Now, another theme that I'm watching that is fitting within all of this, the inflation, the money printing, the interest rate rising, what happens as the dollar weakens? Well, oil, the master resource that we need to produce everything, a lot of times that raises in value. It did in 2021 and 2022. It did in the 70s, did in the early 2000s. So for me, I invested a ton in oil back in 2021, right as the president was getting elected, and it seemed to have bottomed again off the bottom at the same price when oil was negative. It followed one of my investment principles: buy things when they're cheap. And oil was cheap. Now I don't think it's cheap, but what I'm doing is following the trend, watching the market to tell me what to do next. And what was interesting here is OPEC slams the IEA for this dangerous forecast. The IEA is the International Energy Association, I believe, if I'm pronouncing that correctly, just going off the top of my head. But what they do is they talk about the energy. And apparently, according to them, they don't think we're going to need much oil in the future. Well, I beg to differ, because if you look around, we're driving cars, we're producing power with natural gas, plastics everywhere. There's plastic in this camera I'm talking to you from, there's plastic in my computer, there's plastic all around me, and that all comes from oil. So if you think that's going to go away tomorrow, I really don't think so. In fact, I encourage people to think that it's going to go away so that oil goes down even more and I can buy more of it, because people who are very smart about this seem to think there will be shortages of it in the future. And you know what? People think they don't need something, yet they do need it. That's where you can make big money when the market is completely wrong. Now, don't misquote me here. I'm not buying here because it's not cheap. If it went down to a very, very cheap price, like below the cost of production, then I would be scooping it up hand over fist. But right now, all I'm doing is watching to see that the trends are intact. And it seems to me like we're using more oil than ever. People keep saying we're not going to use it, but I don't think that plastic goes away. It takes oil even to make your electric cars. So let's continue. Another thing that came up this week that I've been watching. This goes along with the theme, and this is all I'm doing is I'm maintaining my vigilance on the market to see if my themes are intact. And one of the themes that we're talking about every week is they're going to continue to debase the dollar. And this should mean that gold goes higher. And if you look at this chart here, it shows me that central bank gold purchases have been up in 2022, 2023, 2024. You can see that they're up significantly higher than any period from 2010 to 2020. And if more people are buying, that should mean that the price goes up. So all I'm doing is continuing to watch this theme that if central banks are buying, pushing up the gold, eventually the gold miners that I invested in back when they were cheap, the other year, they should go up. Now, they've only moved a little, but I expect in the future, if this theme continues, this is another theme I'm watching closely. This way, I can take advantage of the market instead of getting taken advantage of. And finally, the one thing that I want to point out that I think is the most important, we're still on the AI theme. AI is going strong. And yeah, I've been nervous about the job market and I've been nervous about the unemployment rising. But as long as the market's going up, I'm going to be invested in the themes that I think take advantage of this situation. And one of the themes that I'm watching right now is the theme of AI. And you know what? It's reflected in the stock price here. NVIDIA has been going up and up and up. All the memory chip stocks have been going up and up. I've been invested in those since 2019 because I believe we're going to use more memory and more chips in the future. Certainly tomorrow we're going to need more chips than we are today. And until that changes, until the market tells me something else to do, I'm just going to watch it and maintain my positions that are taking advantage of these themes. Until the market shows me something that I should do next, I'm not doing anything. So I'm cautiously optimistic here. And of course, I could change my mind immediately tomorrow if the data tells me different. But right now, this is just what the market's telling me. I'm cautious, but continuing to be invested. So let's see what happens next. So hit that like button, subscribe to this channel, and I'll see you next week when I do a recap of what the market is telling me. How am I using this information to protect and grow my wealth? Go to highreturnlowrisk.com.